Hello, everyone. This is Katie Novotny calling in from Premier Marketing. First and foremost, I want to thank you all for attending today. I really appreciate it. We have seen a lot of changes in LTC, and I feel like that's been my message for the past 18 months, but truly, every time I turn around, there is something different, something new, some product being tweaked, edited, or overall just changes within the market itself. We have seen various carriers step up to these challenges that we've seen in the past 18 months, and one of them specifically is Securian. Today, we are thrilled to have John Thomas from Securian here to talk about their long-term care solutions, some ideas, and overall marketing LTC in our new quote-unquote normal. So with that being said, John, you ready to take it away?
I'm ready. Thank you, Katie. Appreciate that introduction and setting the stage for our conversation. Yeah, absolutely thrilled to be with you all this afternoon. As many of you are experiencing the new normal, I am as well. We're as a company, Securian Financial, all of us have been working from home, and we're starting to evaluate back to the office and back to travel, as I'm sure many of you are. So I am at my home today, but looking forward in the next probably 30 days, hitting the road and being able to meet financial advisors and agents in person. So hopefully you're in the same boat, that you're getting close to getting to in-person meetings, because it really is valuable to connect with each other face to face, right? And we're seeing that as a result of COVID, that we've been disconnected, and now there's this rush to get out and see each other face to face. So I hope you take a little bit from this presentation. As Katie said, we're in a new normal, and COVID has affected the market to some degree. It's affected how we think, how we're planning. It's affected the financial concerns of our clients. And so I'm going to talk a little bit about that today. Hopefully you maybe take something away from it, take some notes. There's not going to be as much to show you on the screen, but I want to talk about COVID and its impact on our clients' financial plans, their concerns, and what some of the research is showing us. So we'll be about 30 minutes here, and then I'll talk about our solution, our long-term care solution in the market, and really why it's uniquely positioned to address some of these new concerns our clients have. But before I jump into that, a little bit of background on Securian Financial. If you don't know Securian Financial, we've been around for 140 plus years. We're a top insurer in the country. You may know us under the brand name Minnesota Life Insurance Company. Minnesota Life, and so we are one in the same company. We're a mutually held company, which is important when you're representing a company to your client, right? That it's a strong, stable company that's going to be around in the future to deliver on promises, because that's really what insurance is, right? It's a promise to pay something in the future, and so you want the company that you're representing to be around to deliver on those promises. We've got, as a mutually held company, we've got great ratings, a top Comdex rating, 96 out of 100, which is really in the top tier of insurance carriers. And so that really speaks to how we're well positioned to weather future storms and be around to deliver, right? So as we get into our conversation here on financial planning and our consumer's mindset, right? There's a great study that Life Happens and LIMRA puts together. If you're familiar with Life Happens, they're a life insurance nonprofit company, and LIMRA is an organization that puts together a lot of life insurance and insurance and financial product stats. But they do a great study on financial concerns of consumers, what they call their insurance barometer report. And not surprisingly, in 2019, retirement savings top that list, right? Retirement savings is ultimately our consumers, our clients' top concern, that they're working their whole life. They want to know that they have enough saved to retire one day. Second to that is long-term care expenses, right? Because that really is the greatest risk. Long-term care expenses and medical expenses are the greatest risk to a successful retirement outcome, right? If you've adequately saved for retirement, the biggest thing that could potentially blow that up is having long-term care expenses and medical expenses in your retirement years, right? And so that's 2019. Now fast forward to 2020 and this year, right? COVID happened, and our consumers' mindset has shifted in a big way. right? So COVID-19 affected nursing homes. If we look at nursing homes, you know, and you probably saw it in your personal life. I had two family members in a nursing home pass away over the past year, right? And so the nursing homes were really ravaged by COVID. So not only the folks that we lost in nursing homes, but folks were leaving nursing homes if they could move back out of the nursing home to be with family. We saw nationally nursing home occupancy decrease from a little over 80% to about 65% at its low point just early this year. And so folks are leaving nursing homes if they can. And so it's causing those of us in our middle age, right, to reevaluate what we want our late retirement years to look like, right? We're thinking that, we saw our family members go through this challenging time, and we're reevaluating what we want our years to look like. We certainly know that we don't want it to be in a nursing home, right? If there's another pandemic or illness, we can foresee that nursing homes will be the hardest hit, right? And beyond that, we're reimagining a care experience or elder experience that's a little bit better than those before us had it, right? And so nursing homes have certainly been ravaged, right? And not only that, COVID has some long-term effects. So COVID-19, not only for those that had really significant infection, but even those with mild cases. Research is showing that there are long-term effects from COVID, right? Whether it's heart issues, that imaging tests have shown that the heart has some long-term lasting damage in the heart muscle from even a mild COVID case. The scarring in the lungs for mild to medium cases, there's some long-term damage there. Or even COVID that stays active in the brain tissue for a long period of time. They're even seeing this in young people. And they're concerned about issues of Alzheimer's down the road and higher rates of dementia because of a COVID infection, right? So these diseases do potentially affect our longevity and mortality. We saw mortality decrease, or I should say increase for the first time in several years, right? Because of not only those folks that we've lost, but because of some of this long-term effect of COVID. And so that's something to keep in mind, that our consumers, our clients are concerned about not just staying out of a nursing home, but also if they've had COVID, maybe they're a higher risk to need care down the road. Maybe they don't know it, but they have some of these long-term effects that are research is starting to show and doctors are starting to talk about, right? Beyond that, there's been a change in care and the longevity of care. AARP puts out a great study, and they put out a study last year that looks at caregiving in the United States. And it explains the caregiving story over a period of time, and it looked at even the last decade or the last 2 decades. Well, believe it or not, from 2015 to 2020, just in the last 5 years, there's been a 30% increase in folks that needed care for longer than 5 years. And it's estimated that COVID will lead to an increase in this risk because of chronic illness. Well, first of all, medicine's advancing, right? It's helping us stay alive longer, but there's also been an increase in chronic illness. That there's been a 70% increase in Alzheimer's and dementia in the last decade. There's been increases in other chronic illness. And so not only are folks increasingly needing care, but the duration of care has increased quite significantly. So a 30% increase on folks that need care for longer than 5 years is really significant. It caused them to adjust the average length of care. What was prior to 2015, it was just under 4 years. That's been increased to about 4.5 years as the average duration of long-term care need in this country. So significant a risk there. And then as we talk about long-range planning, the last piece of that study that I'll mention that's interesting is that study, that AARP study. It talked to individuals in the caregiving situation. So nationally, thousands of individuals that are providing care and those receiving care, and it asked the question, did you have any plans for future care? And 54% of care recipients, those that were receiving care, said they did not have a plan prior to ending up in a situation where they needed care. So over half of individuals right now that are receiving care ended up in a situation they thought they were going to be okay. They thought they would live a full life, right? They thought they would be able to care for themselves. And over half ended up in a situation where they needed help and did not have a plan, hadn't talked to their family. And so by default, family generally comes around and provides care, right? That's what happens by default. If the family can afford it, maybe they set them up in assisted living or some more hands-on care, maybe care at home, right? But without a plan, family is the first line of defense. If you don't have the assets to help provide care, maybe Medicaid becomes the default option, which really isn't ideal for anyone, right? Being in a Medicaid facility, I've had family in Medicaid facilities. That is not what anyone plans for, right? That is the fallback plan, but it certainly isn't what most folks desire. And so we're uniquely positioned right now, I think, to talk to consumers. Right, there's other studies out there that say that 70% of folks purchasing life insurance and long-term care right now did it because of COVID, because of concerns of COVID. And so the opportunity right now to talk about life insurance and long-term care planning is significant because our folks are in a place that more so now than ever before that they're going to be interested to talk about it. They're going to be interested to make sure they have a plan in place, even if this insurance that we're talking and I present today isn't the solution. They need to have a plan. They need to talk to their family. They need to know what the options are. And so it is a significant opportunity right now to have the discussion with our consumers. And so I hope that was beneficial at talking through some of the research and where we're positioned. And then I want to present or really talk through the solution that we have and why I think we have a unique product that really fits with where consumers may be right now. And so Securian offers a long-term care. It's an insurance-based long-term care solution called SecureCare. It is a long-term care product built on life insurance, or a hybrid product, if you've heard that terminology, or a linked benefit product. So basically taking the chassis of life insurance to provide a guaranteed premium, guaranteed death benefits, and guaranteed long-term care, using that chassis for those guarantees to provide long-term care benefits. And it really is a story of leveraging assets that an individual has to pay for care. Right, that as I mentioned, folks have saved for retirement. They've got this retirement portfolio. Maybe it's in qualified assets, a 401k or an IRA, right? But then they've got some cash. They've got some sitting liquid, or they've got some in bonds, or it's not really earning a whole lot right now. The rates are certainly not where they should be, and so some of that liquid money or money that's in fixed assets can be repositioned to better prepare them for this long-term care risk and cost, right? So we're going to reposition a current asset to provide care. The SecureCare solution really provides a fourfold guarantee. It provides a death benefit should you die and not need long-term care. If you need long-term care, the long-term care benefits are guaranteed. It is liquid. It has 100% return of premium. So if you change your mind, you want to cancel the product, you can get your money back. We offer a one-time payment where you can reposition a single asset, or a multi-pay. You can pay over 5, 7, 10, even 15 years to fully fund this solution. So the fourth guarantee is if you elect to pay it over 10 years, if you stop paying premium or you can't continue to pay, it's fully guaranteed. The policy won't lapse. You'll just have a reduced benefit, pretty much proportionate to the amount of premium that you've paid in. So it's intended to really be a fully guaranteed solution that once you buy it, unless you borrow money out of the cash value, the policy is in force. It's not going to lapse. So to give you a simple example, we use 100,000. That certainly isn't the minimum, but 100,000 kind of gives you an easy idea of what leverage we provide with this solution. So $100,000 with the solution creates a base death benefit. In this example, that base death benefit is about $112,000 on a 62-year-old female. We've added a 3% compound interest rider that will grow the long-term care benefits over time. And so on a 62-year-old, $112,000, it's really not a life insurance benefit. It's not intended for life insurance. It's really a return on investment. I've invested in this thing. If I die, what do I get, right? And so you're going to get back what you paid into it plus a little bit more. Probably what you would have earned in a bond or a fixed investment right now. So you're going to get that back to your portfolio. But if you do need care, that's where the significant benefit is. And so on the 62-year-old, by age 80, you can see towards the bottom right-hand screen that $100,000 has grown to $600,000 in total long-term care benefit. That equates to 6 years of long-term care benefit at $7,811 is that breakdown. So the way that it works, and someone goes on claim, they need long-term care, they file a claim with Securian. We're going to pay out that monthly benefit until the death benefit is exhausted. Once it's exhausted, you no longer have a death benefit, but it will continue to pay until you've exhausted the full $600,000. And this is a further shows the guarantees in the solution: guaranteed death benefit, guaranteed return of premium. If you cancel it, you get your money back. That $100,000 comes back to you. Guarantee number 4, just to highlight, and this is right in our proposal or illustration. If this were a 10-pay, let's say, not a $100,000 single pay, but if we're going to pay $10,000 each year for 10 years, you can see what that benefit would be right in the illustration should you stop paying premium in any given year. So you see there at, let's say, year 6, we've paid in $50,000 over the 5 years, and so there's $47,000 in death benefit, $180,000 in total long-term care, and a monthly maximum of $2,359. So that would be after 5 years of payments. So that kind of gives you an idea of what the proportionate benefit would be should you stop paying premium in any given year if you were to pay over 10 years versus just a one-time pay. And our approach with this really is to give the client confidence, right, that if I'm going to invest in this insurance solution, that I can walk away. Right, I can walk away and cancel it. I can walk away, stop paying premium, and I still have long-term care protection. Now, this table really highlights the power of this benefit for you, hopefully, and for our consumers. Right, and it looks at each of our payment options on a 60-year-old female, $100,000 single pay through a 15-pay of $6,667. So paying that over 15 years for a total of $100,000 over that period of time. Each of these use a 3% compound rider. We do offer multiple options: 3% simple, 3% compound, all the way through 5% compound. The 3% compound, if you're familiar with these products, it tends to price very well with us and provide significant benefit, particularly around age 80, age 85, which is where we target like an assumed claim where that income for the solution begins. So I didn't mention earlier that SecureCare offers this long-term care benefit as an indemnity benefit. So I know many of you are very familiar with long-term care benefits. You understand that there are either reimbursement benefits or indemnity benefits. A reimbursement is very much like a traditional insurance policy, right? You have a claim. You submit a evidence of the cost of your care, in this situation, long-term care, the evidence of the cost, and you're reimbursed what that care costed you, right? In an indemnity solution, it really is a cash income benefit versus a reimbursement of what you spend in care cost. And so as a income, we pay the stated benefit regardless of what costs are. Right, so you don't have to go through the hassle of submitting bills and receipts to the insurance company. But beyond that, it allows for you to receive this income when you need care, regardless of who's providing care, whether it's a family member, whether it's neighbors or nephew or niece, right, or just a unlicensed caregiver that's in the community that may be less expensive than a caregiver with a licensed facility or a licensed agency. So it does open up the door for a little bit more flexibility to receive this income for care and use that however you see fit. And as we look at the leverage it provides, so each of these provide a benefit at age 85 that's significant. And if you see in that final column, the tax equivalent yield, that's where I'll focus. And it shows on a single pay at 10.08% down to a 15 pay at 10.71%. Hopefully you can see that well. And so what that really means is that in an equivalent taxable investment, if you were to invest the same 100,000 over as a one-time pay or over 5, 7, 10, 15 years, it would have to earn at least that 10% to give you the same total benefit that this long-term care policy provides. And so, of course, someone invests $100,000 in the market, they could potentially earn 10%, right? But the power of this insurance product and the leverage it provides is this is fully guaranteed, right? And so that 3% compound growth is guaranteed. And so when someone buys this product, they invest the $100,000, they reach age 85, assuming that's around the time they file a claim, they are guaranteed to get that income stream at a tax equivalent yield of about 10%. And so when you look at investments in the market or investments that have risk, right, you certainly could potentially out earn 10%, but nowhere can you earn close to 10% on a guaranteed basis. And so using the power of insurance, we have the opportunity to really position part of their portfolio in a guaranteed manner, really hedge this risk well. And if we've done that, we've set them up to really protect against this risk well. Maybe they can manage the rest of their portfolio differently. Maybe they can be more aggressive or use some of their other cash to buy a second home or do some other things because they have managed and prepared for this risk very well. And so that really positions a client well in their portfolio to be protected against the risk and maybe do some other things with their investments. So that really is the power. I think we often, in the insurance world, we present these solutions, we understand why they're powerful, but then someone talks to a financial planner, and the financial planner says, well, just invest in the market, right? Maybe you're a financial planner and that's been your mindset, right? Just invest in the market. And I think you certainly can. You invest a portion of your assets in the market, you use that for retirement success, but in your fixed allocation, in your protection allocation, right? Invest some of this in a solution that really is going to give you powerful leverage to protect against this end of life and elder care expense. All right, some additional product features I'll mention, and then we'll talk through a sales idea or two before we open it up for questions. So we mentioned the multiple premium options, that it is cash indemnity, that it offers that return of premium. It's available for folks ages 40 to 75. So the minimum age is 40, the maximum issue age is 75. And for face amounts, life insurance face amounts of $50,000 to $750,000. So you can potentially purchase a pretty significant size long-term care policy. There's also a 90 calendar day elimination period. And so when you have a care need and you file that claim with Securian, 90 calendar days or 3 months from when that need is established, with the client's primary doctor or their doctor, from 90 days from that point is when those benefits can begin. And so, for example, if someone has Alzheimer's, they go to their doctor, it's diagnosed, right, in maybe July, and family starting to care for them. Of course, they're diagnosed with Alzheimer's. They may forget they have a policy. Well, the family discovers that policy in December, right, and the doctor diagnosed them in July. Well, if they have come to us in December and the family says, hey, we discovered this policy, we're filing a claim, it's certainly been over 90 days since that was diagnosed. And so care or that benefit can begin immediately. So it's 90 days from when that diagnosis happens. And I am going to skip through a couple of slides here, and we'll briefly look at tax benefits to talk about some sales ideas briefly that maybe you don't often think about in long-term care planning or with hybrid products. But the way that SecureCare is structured, it is a life insurance policy or life insurance chassis and long-term care benefit, right? An attached long-term care benefit. And so there's a single premium that pays for two solutions really in one. A part of that premium pays for the life insurance policy, and part of that premium pays for long-term care expenses. The way that the IRS views these hybrid products, they say that anything that is paid from cash value, life insurance cash value, cannot be deducted from a tax perspective. From a long-term care perspective, if that premium pays for long-term care, some of that is potentially deductible. And so there are opportunities we present the solution to not only talk about the long-term care benefit, but also do some efficient tax planning. And so the long-term care expenses are potentially deductible. Now, what the IRS says is on an individual basis, there are age-based limits in what you can potentially deduct. So over on the right-hand side, they put out a table based on your age, how much is potentially deductible. So as we think of an ideal client for this solution, our typical applicant is right around 60, 61. Those folks that are preparing for retirement, they're probably have cared for a parent. They're very aware of this elder care risk, right? And as they're preparing for their own retirement and thinking through it, they're starting to think about a long-term care policy. And so our average applicant tends to be around that 60, 61. And as they're thinking about retirement, they may fund a policy a couple of different ways. They may fund it directly, or you can fund a portion from a medical savings account or an HSA. An HSA allows for some funding on a tax preferred basis. And so if someone is funding it individually out of their own pocket, the IRS says you may deduct, if you're 61 through 70, you may deduct up to $4,350. So a portion of what they pay, maybe they're going to set the policy up to pay over 10 years. And the policy, they're going to pay $8,000 a year for 10 years, and they can potentially deduct up to half of that that goes towards long-term care premium. If they have an HSA, they can pay that portion out of their HSA account, that $4,350 out of an HSA. And so that is a great opportunity if you have folks that have accumulated assets in HSA. We have folks that are entering retirement with a lot of accumulated assets in HSA that they're not going to end up using for medical costs, right? Let's use some of that tax advantage money to reposition into a long-term care solution like SecureCare. So that is an opportunity really to help folks not only prepare for long-term care, but take advantage of some tax arbitrage. If it is an owner of a business, an S Corp or a C Corp, this is a great plan to present on an executive carve-out basis. Maybe you have an owner of a business that wants to provide a plan for himself, his spouse, and some key executives, right? They can do a carve-out plan and provide a benefit for their C-suite employees, right, or key employees. And so on a C Corp specifically, you have the greatest opportunity with these type of solutions, because if a C Corp buys a plan on its employees, active employee, they can deduct up to 100% of the premium. 100% of the premium if it's a C Corp, a business. So a business can provide a benefit to their top employees, deduct 100% of it as an employee benefit, and the employee only has to claim a portion of that premium as their income. And so in a lot of cases, they claim somewhere between 30 to 50% of the premium as additional income. And you can structure the plan to really limit what that executive has to claim in the amount of additional income that they receive. So there is a fantastic opportunity. And I'm not going to go into a lot more detail in the structure of that. I will say that Katie and Premier, they are fantastic. Katie is an absolute expert in these solutions. and she can talk to you in a lot more detail about how to structure it, how it works. And then we do have a great material. We have pieces that address individual taxation, S Corp and C Corp taxation, talk through the opportunity, and we have worksheets that someone can take to their accountant to help them determine what amount is deductible when looking at these hybrid long-term care plans. And so we've got some great material to go along with it. So certainly follow up with Katie if you have additional questions or want to go into some more detail. All right, well, we're about at our 30 minutes here, and so we talked through this HSA. I'll give an example here of what this HSA funding looks like, and then we'll open it up for some questions. So let's say Howard is 67. He has an HSA account that's got $35,000 in it. He buys a SecureCare policy, $15,000 a year for 7 years. And so that is a pretty premium policy. It's going to provide great benefits at age 80, over $500,000, even though he's investing at 67. And it doesn't necessarily have all that much time to grow by 80, but still significant leverage. And because he's 67, he falls into that category, those age-based limits of $4,350. And so each year, until he hits 71, he deducts $4,350. At 71, he's in the next age bracket and can deduct or pay from his HSA $5,470. So over that period of 7 years, he's funded $71,000 out of pocket and $33,000 from his accumulated HSA funds. So it really is significant tax arbitrage over a period of time when we structure it in a 5, 7, or 10-year funding structure. What I will say is these are the 2020 age-based limits. They have stepped up just a bit in 2021, and our tax material actually does have the 2021 stepped up deduction limits. So you can see that in our material as well. Katie, I'm going to pause here, and I know we went through quite a bit. I'm sure you may have some additional thoughts or some questions that have come through.
Well, we have a slew of questions that have actually come through, and as we're going through these, please feel free to type in some additional. We'd love to go through them. A couple ones are just, are we going to send out the slides? So what we usually do is we will have a recording of this webinar and the presentation along with any other sales materials. The majority of our carriers, as you guys know, provide us with some great pieces. So I'm sure John will be sending over some pieces that he feels that are most effective right now. Next question
Absolutely.
is going to be, we have some questions on deductibility and taxable events. So is this event taxable for the consumer?
Yeah, so when you say, is this event taxable for the consumer, I think I may know how to interpret that question. When we, I'm going to, well, I'll address a couple of things. So when someone receives long-term care benefits are received completely tax-free. Tax-free up to what the IRS calls a HIPAA per diem. So they give a certain amount that you can receive tax-free. If I'm not mistaken, Katie, and you may know this, I think the HIPAA per diem right now is $12,000 a month. And so you can receive from these policies up to $12,000 a month without incurring any income taxes. So that is tax-free regardless of how it's used. If you have a pretty large long-term care benefit and it pays more than that $12,000 or whatever that HIPAA per diem is in the given year you receive that income, then you have to show that amount is used towards qualified long-term care. You know, if you're in a really nice facility in maybe California or New York or some places that a facility runs $20,000, $25,000 a month, then it's still tax-free as long as you can show it goes towards qualified expenses. If you get over that per diem, but you're just pocketing it, you're just receiving it as income, then the amount over the per diem is taxable as income. So there could be some if you receive a significant benefit. When we're talking about funding, there is no funding that is going to cause someone to incur taxes. So they can potentially take advantage of an HSA or take a tax deduction as an individual or S or C Corp, but they would not incur taxability.
Perfect.
What do you think, Katie? That answer the question?
I think you nailed it. I think that I kind of read the question the same way. And David, if we missed that, if you want to type in some additional questions, feel free. I think what you're asking is receipt of the LTC benefit, and then also the taxation or taxable event that could happen on a death benefit. So another one in here is regarding tax deductibility of your product. Is this based on the medical expense of 7.5%?
That is a great question. It is, yes. So, when we go into some more detail on the taxation, if we're talking about an individual that buys a policy, they do have to meet that 7.5% threshold of medical expenses of their AGI or adjusted gross income before they can take advantage of the deduction. And so they would have to have either some medical expenses or some really significant long-term care costs with maybe limited income to meet that AGI threshold for an individual. So an individual, there are fewer cases where an individual can really take advantage of the deduction. If we're talking about an S Corp or pass-through entity, someone that has a small business and an S Corp filed and they can file taxes under that S Corp, they are able to take that age-based limit as an above-the-line deduction. So anyone with an S Corp, if that age-based limit is $4,300, they can take that $4,003 as a straight line or above-the-line deduction, and they don't have to worry about meeting the AGI threshold. So unlike a C Corp, they can't take 100% of the premium as a deduction, but an S Corp is an above-the-line deduction and doesn't have to meet that threshold. That's a great question.
Perfect. Another question is regarding underwriting. How is this product underwritten, and is it different than traditional LTC?
Yes, great question. Thank you. It is underwritten on a simplified basis. And so when I say simplified, it's intended to be a quick process, I think somewhat differently from traditional LTC. We generally don't order medical records, and the underwriting is based off of a telephone interview with a client. And so when you apply for a SecureCare policy, we of course will receive the policy and we'll do a background check, which is a prescription check, and looking in the MIB, the insurance database, and then we'll call the client to do a telephone interview. Through that telephone interview, we'll ask a series of questions about their medical history. We'll do a brief cognitive screen over the phone if they're over 55. And so it's about 15 minutes where we ask them some memory questions, make sure there are no signs of early Alzheimer's or dementia. And then based off that telephone interview, it's an approval or a decline. It's a yes or no, right? And so it's intended to be a quick process and avoid some of the length of ordering medical records and a full review of medical history. That being said, if someone gets kicked out or doesn't pass the simplified process, we can take it a step further and order medical records and review their medical history and potentially still extend them an offer just at a lengthier process. And so that's roughly 15% of applications don't make it through the simplified process, but do require us to order medical records from their doctor to take a bigger scope of their medical history.
Perfect. I can attest to what John's saying. We have had some really difficult cases come across here at Premier, and the one thing I can say, and I applaud Securian, is you can have a conversation. Everyone knows that we have difficult cases and clients with extensive history. And the one thing that we do have with Securian and a few other carriers is that we can have that conversation. John's the first one to get on the phone and say, explain something to me. So I really do. I have to extend a big applause to Securian and their open-mindedness. Another question is regarding the Washington State Trust. It says,
Yes.
with the new laws coming in Washington, what is the minimum income one should have prior to considering a private LTC plan?
Yeah, that is a fantastic question. And I appreciate the question. So I'm hopefully for everyone's benefit, give a little bit of background. I don't know that everyone is familiar with the new Washington state law, but Washington state passed a law a few years ago, and it is it's the nation's first public long-term care plan through the state of Washington for any Washington state resident. So they passed it a few years ago. It went through a series of amendments. The last and final amendment was I think ratified earlier in the year, and it's going to be effective next year, 2022. And so in 2022, there is a mandatory tax of 0.58%. There's no cap on that. And so they're collecting income tax of 0.58% on all Washington residents. And so what they have said is that to avoid the additional tax, you can opt out of the state plan. And by opting out, you have to have a private policy that at least meets the minimum requirements set forth in the law. And the minimum requirements are being interpreted somewhat differently, but I think the general consensus is that if you have a plan that at least meets the state's plan, a minimum, then you can use that to opt out of the additional tax starting next year. In the state's plan, and I know, Katie, you're talking about this quite a bit, and you're familiar with it, but the state's plan essentially breaks down to $3,000 a month in benefit, and it is a year of benefits, or what they call 365 units of benefit. And so if you're taking the $3,000 a month from the state, it would last you for 12 months or a year. And so that's the state's plan. It really is a small benefit. It's intended to help with the state's Medicaid budget, really shifting some of the costs to Medicaid and Medicare and shifting it to this new long-term care trust that they're establishing. And so it's for those really short claims, the hospice claims and the 8-9 months in a nursing home that really put a drain on Medicaid. And so they're really shifting that and creating this short-term benefit to help with some of those costs. And so your question is great. What kind of income should someone have to consider a private plan? Well, first and foremost, when we underwrite someone, we look at financial suitability, right? And financial suitability is important to make sure that they can afford it. It's not, going to be a financial strain on them. And I would say I would recommend that people think about why the state put this plan in place. Think about the benefit of a long-term care insurance policy and purchase long-term care because they want the protection. If it's just someone that is buying, a minimum plan to avoid the increase in taxation and will probably cancel it in a year or two if they can get away with it, then that's probably not a good fit, right? But I think of the threshold really. It depends on someone's financial situation, right? When you talk through their income, their debt, their liabilities with them, can they afford to invest maybe $5,000 a year? Is that something they can afford? And does it make sense? And so really anyone that I think is earning, in Seattle and in the urban areas, if they're earning $100,000 or more, $120,000 or more, it probably makes sense, not only just from avoiding the taxation, but also protecting their assets, right? Once you're starting to earn that kind of income, you have assets that you want to protect, that you don't want to draw down when you need care. You don't want to, lose all of your assets and then end up on Medicaid, right? You want to be able to pass those assets down to your children. So from a planning perspective, when you're in that six-figure income and you have assets that are starting to accumulate, then you want to protect those assets. And so I think, really from those angles, it makes sense for folks that are in that income bracket. I hope that was helpful and answered the question.
I believe so. We do have another. We have a couple more that are coming in, but I'll tell you what. In regards to time, I think I'm gonna just. I will reach out to you individually. Some of these are regarding compensation. We have a couple more questions regarding taxability. So I will absolutely reach out to you either this afternoon or sometime tomorrow. We do have one question regarding an underwriting guide, if that is available and if that will be sent. So, John, would you be willing to share an underwriting guide with us?
Absolutely. Yes, I will share an underwriting guide, and yeah, it'll certainly give you an idea of what would be insurable, what would knock somebody out of the process or make them not a good fit for this solution.
Perfect. Perfect. Well, at that, John, thank you as always. It was fantastic, very eye-opening. And I want to thank everyone out there. I appreciate you joining. I appreciate you. Oh, we have a few that seem to always be attending, and we really do appreciate the support. And if there's ever anything that you want to discuss, please feel free to reach out. Whether it would be John or myself, I'm sure we can dig in a little further if we don't have the initial reactions or answers that you're looking for. So at that, John, thank you so very much. Everyone out there, have a great day, and I hope to hear from each of you soon.
Thank you, Katie. Great to be with you all. Take care.
Take care. Goodbye, guys.